inflation because the PCE data just dropped. And for people who don't know what the PCE data is basically a inflation report that the Federal Reserve likes to use a lot. Okay, but before we continue, hit the like button and subscribe, and you can just minimize after that, okay? Because I'll be talking about a lot of things, and you don't really need to watch on screen, okay? So anyway, let's talk about PCE. It actually went up by 0.3% month over month, when the expectation was actually at 0.4%. So, of course, this could be bad, this could be worse than expected, this could be better than expected. It's really up to your own, your own thinking, your own opinion, okay? So we have to talk about why this actually might be worse than expected. Okay, first things first, which is we are only getting this PCE data that is reflecting the whole entire February inflation, which means whatever happened in the past 2 weeks, 3 weeks, let's not forget, we got the Silvergate situation, we got the SVB situation, we got the Signature Bank closure, we got the Credit Suisse, the UBS situation. There's so many banking financial crises that's happening in the market. It's actually insane. And what this actually means is that people who are worried that we might be in an extended banking crisis would definitely be curbing the expenditure. And people who think that, we are safe, okay? The Feds are going to bail us out. The depositors are going to get bailed out no matter what, which means FDIC is basically unlimited. We don't have to care. We can just keep spending money with no fear. So, of course, that would kind of be where a lot of people are doing, having that sort of thoughts. So when we talk about expenditures in general, okay, there's only two types of expenditure. One is basically actually spending your money for things that you need to live, such as your food, your oil, things like that. And of course, the other way to spend your money is by investment, such as you're buying stocks, buying luxury goods, buying houses, things that accrue interest over time and just appreciate in general. So, you have to think about it for the worst case scenario, which is for people who think, oh, you know what, this banking crisis is definitely going to be affecting me, which is why I'm going to be spending less money. And if I'm spending less money, okay, I'm not saying that you don't go and buy consumer staples. I'm just saying that maybe you might want to buy consumer staples over discretionary. Okay, maybe you want to go to Walmart instead of going to Target. Okay, for example, like for Singapore audiences. Okay, it's like you want to go to Giant instead of going to Cold Storage. Okay, I'm not gonna spend money in like the Cold Storage or Fair Price Finest or that sort of thing. Okay, some of the items are gonna be overpriced. Okay, I'd rather go to Sheng Siong, I'd rather go to Giant, that sort of thing. Okay, I want to go to the cheapest supermarket to get my stuff. Okay, so consumer staples, most likely people are gonna be flooding over to consumer staples. Okay, so my current argument is that there is a very, very high chance that this whole entire shenanigan that happened in the last 2 to 3 weeks has not really been priced into the market. Okay, yeah, it might have been priced into the market, but it has not been priced in towards the Fed's thinking. Okay, so of course now let's move over to the Feds. Okay, the Feds are most likely going to be thinking, okay, you know what, we want to increase rates. Okay, but they're only left with one more rate increment because according to the SEP, which is the Summary of Economic Projections, we're only expected to get one more 25 basis point increment in the whole of 2023. But of course, there is a possibility that we might actually get a revision upwards in the next SEP, which is in the next quarter. Okay, so this is where it actually kind of differs a little bit. Okay, because effectively, right now, there's only one more meeting before the next SEP actually drops. Okay, so the Feds can easily just raise that 25 basis point, and people would the market would rally, because that means that we are only going to get pauses from now on. And the Feds can just come up in the next meeting and say, psych, we are going to do 2 more 25 basis point increment in the year. That sort of thing. Because even Jerome Powell himself said that, cutting of rates is basically impossible in 2023. That means let's take rate cuts out of the picture, okay, which means that they are not going to be raising and cutting. They are going to raise just nice to that exact certain level and just going to stay there. We're going to get a lot of pauses this year. That's what Jerome Powell is trying to imply in the market, okay? So, no, I think this PCE, it sounds pretty good, Okay, honestly, it sounds pretty good. I think a 0.3 increment month over month sounds pretty good, especially when the whole entire Wall Street consensus was at 0.4%. However, the core PCE price index still went up 4.6% year over year. And of course, this is by no means called low because we're still getting crazy inflation. Don't even if we don't talk about PCE, we talk about CPI, it's the same thing. We're all over 5%. Okay, inflation is still chewing at our money if you leave it in the bank. Well, maybe not in the bank because your money might not even be in the bank, with the whole banking industry and such. But, inflation is still chewing at our money. Okay? So there is a very, very good chance that, the Fed might actually take this into consideration and say that, you know what, we might actually want to raise rates even more than what the SCP actually implies. Okay, but of course, there's going to be another group of people with a different set of opinion, which I can get behind as well. Okay, surprisingly, I can get behind as well, which is the Feds basically want to scare us psychologically into just completely just being worried so that we will stop buying into the whole inflation thing. Because if they are going to give us this sort of front, okay, for example, my first scenario, which is like, oh, you know what, we are going to ensure that inflation is going to be going down. So we're going to imply that there's no rates cuts. We might most likely be even going up with more rate increases. Okay, that's what they're trying to imply right now. And when they actually imply with a quantitative tightening and no quantitative easing to be seen, it means that people are going to be more worried. People might think that the market might actually become even worse. And people are not going to spend as much money. And that's how you can actually bring inflation downwards. Okay? So there is a possibility that the Feds are trying to psych us. The Federal Reserve might think that, we might actually want you to think that inflation is actually going to stay still. And then we are going to actually bring down rates when everyone least expect it. Okay? That's why, honestly, I think the whole entire financial industry right now is kind of weird. Okay, let's be honest. Just take the recession, for example. Okay, when everyone, if your neighbor's gardener know that we are going to be coming into a recession, chances are we're not going to be getting into a recession. Why? Because people who know that they're going to get into a recession are going to be keeping a lot of cash. They're going to be keeping a lot of assets that will not be destroyed via recession. Okay, they might be holding gold, they might be holding cash, okay, they might be holding luxury goods, I don't know, okay, but those people are all holding on to buying opportunities, waiting for the recession to come. So, if everyone is waiting for a recession to come, it means that the recession is not going to come. That's kind of how it works. Okay, if you're expecting for a recession to come, chances are the recession is not going to come. It's kind of a weird thing for the whole entire financial industry as a whole. So yeah, I think that of course, technical recession-wise, I think we already hit it like last quarter. And even for this current quarter, I'm pretty sure that you already saw the SCP, that there is a very, very good chance that we might actually get 0% GDP growth, which means that it's an extended recession as well. So there's going to be a lot of things for us to actually look out for, but right now, inflation as a whole, I'm not sure if this is actually a good news or a bad news. The market seems to be liking it a little bit, okay? Even for the S&P, they're up about 0.5%. You do take note that this is currently Friday in Singapore, which means that it's the last trading day of the week, and I think right now it's about like 10:30. So the market has been open for about an hour or so. So yeah, I think that the market seems to kind of like this report. But like I said, I'm going to be cautious about it, okay? Because unless we see some surefire thing where, inflation actually went to deflation, or we are actually seeing like certain level of quantitative easing, then I would actually be more comfortable in just, getting rid of all my bearish position. But as of now, I'm just going to be biting the rock. I'm going to be taking a lot of my losses, and I'm just going to be holding on to my losses for now. Because, hey, you do not know. I might be losing 10% for this past week. but I might be getting 50% in the next month. I don't know. Okay, that's just kind of my thoughts about this. But anyway, I hope you guys like my insights on the current market and also about inflation data. And of course, if you do like this video, remember, please drop a like down below and also subscribe to my channel. Okay, I'm going to be posting video every single Wednesday and Saturday for you guys. Thank you guys so much for watching, and I'll see you guys in the next one.